All right. So as I mentioned, I'm Laura Cook. I work at Keller Williams, and my husband and I work together. We are a team. We specialize in residential real estate in Manhattan. I have an interesting background. Actually, I have a background as an actor. I came here from Ohio. And I actually worked as an actor for the first 5 years I lived in the city. And I decided, you know what, I wanted to give it a change, career change. So I got into real estate on the recommendation of a girlfriend who was also doing it, who was an actor. And then it took off. So I figured, you know what, this is actually something I really love. I'm very passionate about. And now I've been doing it for about 8 years. We have a top team in Manhattan in the market center. I was in the top 20 agents of about 500 agents at Keller Williams, New York City. And we feel very blessed to be helping people figure out the joys of homeownership. We help people sell, we help people rent, we help people, find their place here in Manhattan. So that's a little bit about us. So don't want to make that too long or too lengthy. What we're really going to cover today, 3 things: the pros and cons of buying versus renting, right? Which is what most people are expecting to hear. The tipping point, what is it and why does it matter? And then understanding the sales market of the moment. So I'm going to make sure that this is interactive. So I'm going to be polling you and asking you questions. So why don't you stick in the chat? Do you think it's better to buy or rent right now in Manhattan? Like if you're going to make a decision today and you had the money, money wasn't an object, you could afford to buy, which would you do? Would you buy or would you rent? Stick your answers in the chat. So let's just delve right in, renting versus buying. So why would you buy, right? Some things to consider. So buying builds equity, whereas renting does not. You get tax benefits when you purchase, and you can deduct all of the interest on your loan amount up to $750,000. Okay, that's the loan amount, not the purchase price, right? You can deduct a percentage of your maintenance for co-ops and real estate taxes for condos up to $10,000. And the interest rates, if you're financing the purchase, are at all-time lows. But the important thing to note is they're going to be going up. Okay, so keep that in mind as we're talking. So let's talk a little bit about what we're seeing in the rental market. So Manhattan rents break another record as market shows signs of cooling. So this is actually from the New York Times just a couple of weeks ago. And they told us that the median rent reached nearly $3,400 in December, the highest price ever for the traditionally quiet month. And that is true. Typically, December is a pretty quiet time in Manhattan rentals. So the median net effective rent, which includes price concessions with landlords, was $3,392 in December, 21% higher than the same time a year ago, and the highest price recorded in the month since at least 2010. Which is interesting. And even in the New York Post, they're saying Manhattan rents hit record high in December as the supply is plummeting. And it's interesting, actually trying to find data on rentals isn't great, but I do have a great chart from Urban Digs. They've started tracking rentals over the last 2 years. Urban Digs is where we pull data for Manhattan sales, and now they're doing rentals. And you can see here, so the blue line is new listings. The yellow line are signed leases, and those green lines that you see going up, that's the median price. And when I say median, that's the middle point. If you stacked up all the prices in a row here, that's the middle point, that middle price. And you can see the trend, from 2020 went down. There was a dip here, and then it kind of climbed back up. And now the median price is outpacing pre-pandemic numbers, which I think is very interesting. So as I mentioned, rent prices are back up, and this is driven by inventory. Vacancy is decreasing, but the thing to keep in mind with rentals, and the reason a lot of people consider it, is because it's lower upfront costs. So some listings are still no fee listings. So what does this actually mean? That means the landlord is paying their agent to advertise the apartment. And also, interestingly, there is a new law that came into effect in 2019 where you can only collect first month's rent and security. You cannot take extra money up front. And any agent who advises you to do that is not working within the bounds of the law, or landlord who asks for it, quite frankly. So let's talk a little bit about rent concessions, net effective rent. What does this mean? It's something that people are very confused about. So when you're looking at a net effective rent price, Let's do an example. So it's an advertising tactic to show a lower rent price, okay? The gross rent price is the actual price that your lease states. It's what you're paying monthly. The net price is what is amortized when you spread out the free months across the term, right? So let's use a real life example. You have the rent that's written on the lease. Let's say that's $2,000, right? And let's say they're giving you a free month. So you're really only paying 11 months of rent. If you multiply the 2,000 times 11, that's your annual rent, which is $22,000. And then if you divide that by 12, then it's $1,833 over the year, right? If you make it monthly, even though you're really not paying it monthly because you get a month free, right? That's the net effective price. And that is a very specific advertising tactic that landlords and agents use to give it a lower price, but keep the gross rent high. So one really great resource to help figure this out, because it can be confusing, like what is the gross rent then? Because a lot of times the agent will just put 1833 and you can't really tell. Now StreetEasy's kind of cracked down on that if that's where you're looking, and you'll see what the net effective price and the gross price is, but other advertising sites don't necessarily have that. So you can go to Brick Underground, and like I said, if you put your info into the Google spreadsheet that I just put into the chat, I will send you this gross rent calculator. It's very easy. You just put what the advertised rent is, the length of the lease, the number of free months they're advertising, and it gives you the actual rent price. And keep in mind, that's what you're going to have to renew the lease on. So like I said, focus on the gross price. The lease renewal will be based on the gross rent. And, as the rental market grows stronger, unless you're in a rent stabilized lease, it will continue to go up, and it could go up significantly. This is what people are seeing right now. The people who got grandfathered into these, very sort of low prices during the pandemic, they thought they were going to continue. And unless it's a rental stabilized apartment, that's not the case. The landlord can hike up the rent as much as they want. Now, the thing to keep in mind is they can't hike it up more than 5%, I believe is the number, at a moment's notice. Like they have to give you notice about that. I think it's 60 days or 90 days, depending on how long you've been in the apartment. But they still can do it. So just because they give you notice, it doesn't mean that it's easier or better, you still have to pay it. So really, what does this mean? Should I buy or should I rent, knowing this, if the prices are up so much? So this brings me to a question. How many years do you need to own a property on average to make it better than renting? What do you think? Put it in the chat. Awesome. So let's delve into this question. So when we're considering this, what we're really talking about is the tipping point, right? So what is a tipping point? It's the number of years it would take for the cost of owning a home to equal the cost of renting a comparable one in the same area. So the tipping point metric weighs the cost of renting, your monthly rent, your payments, your broker's fees, insurance against the cost of buying. So the costs that we're talking about include your down payment, your mortgage, your property taxes, home maintenance cost, but not just that, it's also the opportunity cost of investing that down payment, which is significant in New York. It's usually at least 20%, that down payment and upfront fees in alternative assets such as stocks and bonds. And the tipping point really depends on the property, where you're buying, what neighborhood, how big is it? This can really vary widely. So there's some resources that I want to point you to. So this map is actually one that I pulled from StreetEasy, where it grabs the tipping points from different neighborhoods. So the darker the color, the higher the tipping point, meaning the longer you need to live in it to make it worth owning versus renting, right? So you can see, I just highlighted Midtown East. So it's about 6 years, in Midtown East on average. Yeah. Also, you can look at this. This is also the StreetEasy kind of tipping point calculator, where you can just throw it in there and say, okay, so if I'm buying an Upper West Side 1-bedroom apartment, on average, that might cost $800,000. And that similar home costs $2,800, give or take. And then if that's the case, your tipping point is about 4 years, right? So it really depends on the neighborhood, the asset class, and what the rents are going for in that neighborhood as well. Now, this is a fantastic tool. This is much more interactive and deeper than the StreetEasy tool. And I'm actually going to stop my share and show it to you for a minute. All right. Can you see that? It's New York Times.
Yes.
So it's very interesting, this calculator. Is it better to rent or to buy? So I actually stuck in some real life numbers here. You can see this is actually a real example. Someone that I was working with bought in Hamilton Heights, a 2-bedroom, for around $650,000. And I put in, they planned on staying about 7 years. Their mortgage rate was 3.4%. You might even be able to get lower than that nowadays. Their down payment was 25%, and it was a 30-year fixed mortgage. But it also, so you can see, it talks about what does the future hold. So what's the average home price growth rate? What's the rent growth rate? And then the investment return rate and the inflation rate. Now, these are sort of hypotheticals, but they're projections, and they're based on some real numbers. Also plugged in the real property taxes and what the tax rate might be, their own tax rate, as well as closing costs to purchase and to sell, right? And then your maintenance fees, do you put some renovation into it, some homeowners insurance, monthly utilities, on and on, and then the cost of renting, what it might cost. Actually, this should be maybe more like an 8% because people are starting to have to pay brokers fees now. And then renters insurance. So, the home that they purchased would probably go for about $2,900 to $3,000 a month. So if they're planning on living it for 7 years, it's actually much better to buy. And you cannot find an equivalent home for less than $2,100. There's no way, just no way, because it's a 2-bedroom. So the point is that this is actually a really easy thing if you're trying to figure out your own situation. And you can use some real life examples, and I help people through this as they're looking at, okay, so, I really do want to stay here for 10 years. What would that look like? I'm looking at this property for $1 million. Should I rent it instead and then just invest the money somewhere else? So this is a really helpful tool. And like I said, if I have your information, I will happily send you that information. So let's stop that share real quick. All right. So just to recap it all, the pros and cons of buying versus renting, right? So obviously owning has the benefits of fixed financing. You've got growing equity in the property. You've got price growth and tax benefits, as we talked about. The costs are a significant down payment, monthly mortgage payments that you have to make, property taxes, other building fees, and closing costs. As far as renting, it's much more flexible. That's a big benefit. And then you can take that money and put it in investments. The costs, though, are the monthly rent, broker's fees. As I mentioned, we're starting to see those come back because inventory is low. That means the broker's fees come back. You have a security deposit that's tied up for as long as you live in the property. And then obviously rent appreciation, which is the number one reason that it's not a great idea to rent long-term. Does anyone have questions at this point? So let's take a look at the sales market in context. So what is happening in this pandemic real estate sales market? I mean, the pandemic has been going on for about 2 years now, right? So we had a COVID-19 slowdown in 2020, and there was a post-election bump in activity. And everyone wants to know, are there discounts, right? This is very price point and neighborhood specific. And the inventory is less right now than pre-pandemic levels, which I think is really interesting. So why buy now, right? So New York is a very stable market, and the wealth is made when you buy. And there's still more negotiability than you saw even in, for example, 2015 and 2016 at the height of the market. And it's always been a blue chip asset. And as I keep saying, the cost of money right now is very cheap. The Fed has said that they're going to be raising interest rates potentially up to 3 times this year. So you have to kind of watch that. So interest rates, why do they matter? So let's look at an example. So let's say that you had a home that you wanted to buy for $800,000 and you wanted to put 20% down, and you could get either a 4% interest rate or a 2.7% interest rate. What does the difference mean to you? Now look at your monthly payment. In this case of 4%, your monthly payment is $3,100, give or take. And if it's 2.5%, it's $2,679. That's a pretty big difference. So what does this actually mean? Your savings over 30 years is $159,000 and change. that's a down payment. So the point is that, where we see interest rates right now, and again, I'm not a mortgage professional. I have those who I can connect you with, but what I'm hearing them say, we're in the low threes, around, low threes in terms of a 30-year fix, depending on what your credit is and, how much you're putting down. But the interesting thing is that we're going to see it creep up. We expect that it'll be about 4% at the end of the year, somewhere in that range. So it could make a substantial difference. But the thing is that it's not going to affect the market enough that it will soften the market too much. So that's the thing to keep in mind. It'll make your affordability go down a little bit, but it's not necessarily going to change the asking prices that much. So that's the reason to jump right in. So let's talk a little bit about the stability of the market first. So I bring this chart to you because it's a really good example of how the New York market reacts to various things. And the pandemic has proven this to be true as well. So these are two big events that have happened in recent memory, other than the pandemic, that affected the real estate sales market in New York City. And both of these things happened in New York, right? You had the financial crisis of 2008, which was the Lehman Brothers, that whole thing when everything fell apart, and that was very New York centric. And then you had September 11th, which was a terrorist attack in New York, right? So you can see this is the inciting incident here, and both markets reacted differently, but about 6 quarters later, it had stabilized, right, back to where it had been. And it's interesting because I've heard someone say this, and it's true. New Yorkers have a very short memory for traumatic events, and the pandemic has proven this also. So this is why I want to bring this to your attention, because New York is a very stable market. So let's take a look at the numbers now. Supply. So just to give you a little context, supply in Manhattan is just under 5,000 units. To be a balanced market in Manhattan, it's around 7,000 units. So the less the supply is, the more it trends towards the sellers in terms of the negotiation, right? So it's interesting. If you look at the chart here, can you all see my little pointer? I think you can. This is the pandemic when it hit, right around here, and then it bottomed out because people pulled their properties off the market. And then interestingly, once we were able to show again, all of a sudden, everyone was putting their properties on the market. And now you almost had 10,000 units, which was a lot. But as fast as it went up, it went right back down, right? And now you can see supply is lower than it was before the pandemic, right? So that's a very good point, because if you're thinking about investing in a New York City property, even though you might have some immediate volatility in terms of supply, it's pretty steady over the long run, right? Also, if you take a look at the market pulse, this is how we try to figure out if it's a seller's or a buyer's market. So this has to do with how many properties come on the market and how many properties go into contract. So if you have a 1-to-1 ratio, that means 1 property comes on, 1 property goes off, or 10 properties come on, 10 properties go off, whatever that ratio or number of units in that ratio is. You can see 2020, this is where it bottomed out, but look at how fast it rose back up again, right? So we're solidly over Manhattan in a seller's market. And that doesn't mean that you can't buy. Just let me be clear. There's plenty of opportunity. Also, the price per square foot. Now, this is something that I like to show, because you can see this is where the financial crisis hit and the effect. And then it slowly rose up. Then it kind of climbed back down after the height of the market in 2015. And then it sort of stabilized and normalized, right? So you're not seeing these big jumps in price per square foot based on things. And keep in mind, because real estate in New York City is pretty illiquid, and more so than any other place, because it takes a while to sell these properties, you're not going to see it react like the stock market, right? Also, what I did here to make the point is I took the price per square foot and then the supply, right? Just to give you an idea, and I overlaid it, right? So you can see, even though you might have a lot of inventory, it didn't bottom out the price per square foot crazy. So even though you see that little volatility, it doesn't change the prices that much, right? You have maybe a little more negotiation if you've got more properties, but it's not like you're going to buy something that could bottom out, where you're having to take 20, 30% off the price, right? Any questions at this point? Okay, so let's talk about the negotiability of the market. So here's a little case study for you. I just sold this property in Hell's Kitchen. It's a $600,000 apartment, 1 bedroom. It was listed, in towards the end of Q3 last year. And this is when the market had really kind of picked up. What would your offer be? And it's renovated, it's in good shape, it's a nice size, it's got nice sun. What would your offer be on this property, knowing what we've talked about now in terms of, the market, what we're seeing? Put it in the chat. Just an educated guess. You don't have to know too much. Erica, what do you think?
I was going to say 625. I was writing that in the chat.
Oh, nice. That's a good guess. Anyone else? Anyone else brave enough to venture a guess?
Fiona thinks 650.
650. Nice. Fiona's an aggressive purchaser. Anyone else have a guess? All right, so we're going to table this and I'm going to come back to it. So it's interesting. A lot of people, buyers, still some, not all, still think that it's a COVID discount market. And there were a lot of news articles in the middle of COVID saying things like the median sales price fell 17.7%. Now, keep in mind, just because the median price fell doesn't mean that the actual property value fell 17%. So if you had a property worth $1 million, right, it doesn't mean that it's now worth just over 800,000. That's not what happened. The median is the middle point of all the trades. So it just meant trades were happening a little bit lower, which makes sense, actually. So let's look at the median listing discount. So you can see the most high market, tight market cycle, most recent was, as I mentioned, kind of in 15, 16. You can see what it did, right after the Lehman Brothers incident in 2009. But we haven't had that kind of negotiability since then, not even during COVID. Okay. So the median discount right now for December was 3.9%. That's a median discount. That doesn't mean that everyone is getting that, right? So that's pretty decent, but it's not, it's not huge. So the negotiability really does depend on the price point and the neighborhood and what things trade for. So knowing that, would you keep your offer the same, Erica, or would you change it?
We would both change it.
What would you change it to?
What did you say the median was? 3.9?
It was 3%. Yeah.
3%. So then if it's 600, so then, and this looks like an above average property. I wouldn't say
it is. Yeah.
Property. So I would say maybe 1% lower. I don't think I'd go more than that. 1% lower.
Yeah. Well, it's interesting. What ended up happening with this particular property was we listed it right at that $600,000 price, which opens up 2 searches. And we had someone that came in who had just lost something recently. And so what they ended up doing was they put in an offer at 610, all cash, and we just took it. Like there was no bidding war. It didn't need to happen. And the owner was happy with the price and it was simple. So, and
so Fiona was aggressive. Erica was kind of close.
Yes, you were close. You were close. Yeah. And again, it's like you kind of negotiate. You can't necessarily negotiate in a vacuum, right? Like you have to take into account where the comps have traded, obviously, and are you up against other offers? Is there bidding war? On and on and on, right? But we got that offer within the first weekend, and we just took it right away. So we didn't have to really putz around. So, but good guesses.
Thanks. Good job, girl.
Thank you. So what does this mean? You don't want to be too aggressively low in your offer. Obviously, if you're going to be making property offers, you want to look at the data and you must be able and willing to negotiate. And if you think you're going to get 15% off, it's probably not happening. Unless the property has been sitting for a really, really long time and they're just that overpriced. But the fact is that if they're sitting there, then the owner may not be reasonable anyway. Make sure that you position your offer carefully with your agent. Obviously, And, you know, at the end of the day, you will be in much, much better shape. So let's talk about final thoughts. So it's really all in the timing. So on average, the process of buying takes about 3 months in Manhattan once you've secured a contract. So if you're thinking, oh, you know, I'm going to buy this spring, you know, my lease is up in May, then you're already sort of behind. In which case I would tell people, negotiate with your landlord to see if you can extend on the back end as needed, because you don't find the property usually in the first go, right? Like it takes a little time. So anticipate that, especially if you're financing, things can take longer. You just kind of have to be flexible here, specifically in Manhattan. If you're not sure about your future for the next 5 years and you want flexibility, then definitely rent. Right now, it may not be the best. Now, if you end up looking back 5 years later and going, well, I could have bought, then maybe that's not ideal. But if you really, really don't know, then you shouldn't purchase something and then turn around and sell it, you know, a year later. That's not ideal. Now, keep in mind, having a fixed cost in the mortgage payment is very close to as good as having a rent stabilized apartment, right? The mortgage payment's fixed, but keep in mind your common charges or maintenance, if it's a co-op, are not fixed. If you know that you plan to stay in the area and you have the down payment saved up, it's typically 20% plus post-closing liquidity. That is definitely the time to buy. It's a no-brainer. And then what I always tell people is buy the largest apartment that you can reasonably afford. That's always the thing. So even if you're trying to save money and buying a studio, the studio is not going to appreciate the same as the 1 bedroom. So buy the 1 bedroom always. So just a quick review on what we do for clients in case you need us. When we're working with buyers, we like to customize searches, make sure that we help you find what you're looking for. We do professional property evaluations. We help you negotiate offers. We coordinate the transaction from start to finish. It's complicated here, and we work to make it simpler as much as we can. We prepare your paperwork. We do your walkthrough and your closing, obviously coordinating with attorneys. And really what we're looking for is a long-term relationship. That's the goal of our business. So that's it. Do you have any questions? I'm going to stop my share.